Joining us now is Eddie Ghabour. He's the co-owner of Key Advisors Group. Eddie, always good to have you with us here.
Thank you so much for having me.
FedEx earnings, is this a warning sign to the markets?
FedEx earnings really should not have been a surprise. They've warned us about their earnings growth, and frankly, because they're the largest e-commerce delivery of packages, we know Europe and Asia has been slow. So this is basically a reflection of how slow it is overseas, and this stock itself has a lot weighing on trade. We get a trade war with China, I think this stock has a tremendous amount of upside.
If we solve this trade war.
That is correct.
I mean, but what does a meaningful solution to the trade war look like for FedEx?
So I think a meaningful solution is to make sure that the tariffs are within reason, that there's not going to be excessive tariffs, because that is what's killed the international markets. You look at Asia, you look at Europe. And so once we get closure and direction from there, I think their economies will find the bottom, because they have been suffering for a couple of years now.
How should analysts, how should investors, how should other companies read into FedEx's quarter and FedEx's outlook for the rest of the year? What does that say about China? What does it say about Europe?
So there's no doubt they're having a major slowdown globally. And the big concern that we have is if this lasts much longer, it will eventually spill over to the U.S. We are a global economy, but our economy has been very, very resilient considering how slow it's been overseas, which is very impressive.
In terms of trade, you're optimistic, it sounds like, that a deal is going to be reached. Is there a timeline that you expect?
I would expect by June. Okay, that's our expectation, because I think if it goes past June, then you're going to see the markets really get real skittish like we did in the fourth quarter and have major volatility that could lead to some more downside to the equity market. So I think there's a lot invested for the U.S. and overseas to be done by June.
And do investors think that that's a win by the Trump administration? Because a lot of the conversation, right, is that if he wins a trade war, that is good for his base, for 2020 prospects. But do investors buy into that?
I don't know whether or not they care. They want closure, but I do think from a political perspective, it will be considered a win for the Trump administration, because the China trade issue has been something that has been worked on other administrations, and really nothing has been able to be done because it's such a difficult task to tackle.
Okay, so what does that trade deal look like?
I don't think we're going to get an overall comprehensive deal at one time. I really think it's too big of an animal to tackle at one time. I think what we need to see is that there is moving in the right direction. So I can see it being piecemealed, again, starting with a big part of it by June, and then we will see how it goes.
What about a curveball from the Fed today? Are you expecting that?
Oh my gosh, I hope not. So a curveball, the market right now is pricing in a dovish Fed, and that we will see no more than 2 rate hikes for the rest of this year. I personally don't believe we'll see more than 1 rate hike. So I hope the Fed stays consistent with their message, because they've already pivoted once in December. If they pivot again, then I think you question their credibility.
So why do you suspect now just 1 rate hike for the rest of the year?
Because I think, again, trade has a lot to do with the global slowdown. They don't want to invert the yield curve. The yield curve between the 2 and the 10 years is about 17 basis points right now. And an inverted yield curve generally is a sign of a recession. So I think we have room for 1 more rate hike this year, because I think the second half of this year economically in the U.S. may surprise to the upside.
Do you think the Fed has enough room to handle some sort of macroeconomic catastrophe by lowering interest rates significantly?
There's not as much as they did in the past. I mean, let's face it, there's not as much ammunition, but I don't go with the theory that they need to raise rates aggressively for the next crisis, because that might cause the next crisis. Right. So they're going to have to be creative in their monetary policy.
What about expected inflation and the idea that unemployment rate is low, and if you follow traditional macroeconomic theory, in times of low unemployment, companies have to pay employees more, which leads to companies charging more for products in order to support those paychecks, which leads to inflation. And the idea of expected inflation plays into how the Fed is, of course, thinking about increasing interest rates.
Without a doubt, and I think the biggest surpriser to economists and everyone, myself included, is inflation has really been tame for a long period of time. I think with the last wage growth numbers that came out, we had the highest wage growth in 10 years. So that will trickle into the economy with inflation. So I think we will start to see some inflationary pressure over the next few years. And don't get me wrong, I expect the 10-year note to slowly rise over the next few years. We are going to be in a rising interest rate market environment, and I think it's healthy.
Are there any parts of the economy that concern you right now?
You know, from an economic standpoint, I think anytime you've had this long of an expansion, okay, you do start to worry about the labor market because we're pretty much at full employment right now. And so the one thing that would concern me is if we do get a surprise to the upside in inflation, and then the Fed has to accelerate their rate hikes. That would be pretty devastating to the markets.
What about auto loans rising to a record 7 million just in recent weeks? Is that at all a concern to you, any sort of bellwether of the economy?
So that's a great point. I think debt in general is a concern. So to add to your question and elaborate on that, another area is corporate debt. Okay, corporate debt levels are pretty high. And debt and leverage is fine when the economy is booming. But when the economy starts to slow down and rates go up is when they have a problem servicing that debt.
Auto loan debt, corporate debt, $1.54 trillion of student loan debt. How do you think about student loan debt in terms of the economy in the next few years?
So the problem with the student loan debt is it puts these kids that are coming out of school in a bad position. You know, they can't even find a job that pays high enough to be able to service that debt and carry a good standard of living. So it is a problem. It's a big problem. I don't know what the solution is, but there has to be some type of solution to how high the cost of education has been rising over the years.
Yeah, I think a lot of people are hoping for a solution to that.
Yeah, and it can be a real drag on the economy, too.
Yeah, without a doubt.
Eddie Ghabour is the co-owner of Key Advisors Group, and he joins us live from the floor of the New York Stock Exchange. Eddie, great to see you.
Thank you.